Buddy. Oh, good. We're recording.
Oh, yeah.
I'll start over. Good afternoon. Or if you're here on the West Coast with me, still good morning. Stepping in, it's almost like stepping into the market and just kind of going to it. So from what I understand, that what we're doing is that I'm answering your questions that you may have about a particular stock or an index. And so let me just give you some quick background on me while you might be submitting some questions, and then we'll take it from there. Again, my name is Michael Filighera. I have been trading professionally since 1979, and I have been a market maker here on the Pacific Coast in San Francisco. Also, I have traded on the London Traded Options Market, the European Options Exchange, and on the German DTB, before returning back to the United States, where, of course, I went back to the Pacific Exchange. And from there, I decided to leave the floor when things got a little bit too quiet and everybody was already going off floor. And so I set up in my home office, and then in continuing to do always Elliott Wave. And that's actually been my main tool for analysis. But now, besides Elliott Wave, then I've added Fibonacci to that, which go hand in hand. And then I left options trading in favor of becoming a day trader. And so that is what I do now. And I currently trade the NASDAQ primarily, the NASDAQ future, but also follow the S&P future. And so I have a daily video cast or blog cast that it's an update that I put on YouTube. So I have a YouTube channel, and I provide that information each and every day, Monday through Thursday. And then I do on Sunday. So actually it's Sunday through Thursday. So it's all the trading days. So I guess where I'll begin, since we're talking about analyzing, and I'll begin with my picture for the S&P. And right now, my hourly chart, you can't really see my bigger count. So I'm going to move my chart out to the 4-hour chart. And that gives a little bit of indication of what is going on. And your answer, 97664, am I a profitable day trader? Yes, yes, and yes to your question. It would be unrealistic to say, do you make money every single day? But I am very fortunate that I managed to at least book something, and I am pretty good about hitting a stop. And then if it's reaching my daily down limit that I want to risk, I do stop. So primarily, I trade about 2 hours in the morning. And being that I am retired, I do continue some days to trade, like yesterday. It was a big news day, the Fed decision, et cetera, et cetera. So there was plenty to do. And so I can. Got to figure it out, because it is traders helping traders, and then it's my name. I don't know exactly anything beyond that, because if I were to just put, I don't know where to find the URL for my room, and I actually have somebody who handles all of my website stuff. So that would be part of that. How do I identify a choppy, untradeable market? There you go. That's how that works. How do I identify a choppy, untradeable market in real time? I'll tell you, I'm going to switch my screen, and then let me drop out of that one and go over to this screen and share that one. And if I close that and close that, you should now be able to see, my screens that actually are showing the NASDAQ future and by some of the trading that I've done today. Can you guys let me know? Can you see that? I don't see my little green line, so hold on one second. I'll share the screen. I'm going to share that. I'm sharing my screen. I'm trusting that this is what is showing because it's not coming in. I usually get a green band that comes around my chart. So I'm going to stop that again. And how I determine that a market is actually in chop. This is, all right, I'm going to go back to my other chart, is that what happens is I trade off of a 5-minute chart. And sometimes it's a little bit more difficult to identify chop. So you can almost come down to a 1-minute chart if you're looking at it on that minute of a level. And you're going to see chop because the market is having trouble moving in any direction. Now, one of the things that I also do is you'll see that I have a bunch of numbers and a watch list over here. And so I get to see within the NASDAQ what is trading bullishly and what's trading more bearishly. And so having an idea on what actually the weighting is of these individual stocks within the NASDAQ and the S&P does allow me to kind of see, okay, I got Apple going down and I've got, another major weighted stock trying to go up and they're not matching. And so it's going to be a battle back and forth and it'll produce chop. Also, you can determine real quick when you're kind of coming into a 1-minute chart to see, you get charts like this, a big, huge engulfing bullish, and then it's replaced by a bearish, and then you get another one that goes this way, and another one, and that just is chop and it's setting a range. This would not be chop. On the way down, it was pretty choppy. And what I mean by that is it's like, again, just breaking this down even further, you can see it's like tick up, tick down, tick up, tick down, tick up, tick down. And that's what I'm trying to show on a different chart, which is this one. Can you see, sharing is paused. Let's see if I can get this to work this time. How about if I go with that one? Oh, control. How about? All right, I should come up. Can you see this? Can you now? It says you can see my screen, so I'm trusting that you can see this screen. So on this 1 minute,
seeing, yeah, I'm seeing a different set of charts now.
Oh, perfect. Okay. So this is a 1-minute screen, or 2-minute screen. I can go down to a 30-second screen, and it could actually even show more. So, let me open that up a little bit so that we can see. You can see that this basically is chop. Then we get a nice little move. Then it moves back down. So as long as I can see those, this I'll sit out of, because the market is not really up, making its mind up. It's not really trading, and that could be due to many different factors that kind of come in. But more important is just recognizing when it is chop versus when it is running. Now, if you're trying to trade off an hourly chart, you're going to have a lot more trouble, and you're going to be looking at. So I do have an hourly chart on here, so let me go over here. So you're going to go here, and that would be chop. But guess what? That's on an hourly basis, but not bad. Those are big enough where you can get in and out and in, and you can trade that if you're patient enough and you're working off of signals that you take. Now, they may be different than signals that I take for day trading. So this screen actually is showing an order volume profile. And what that profile is basically just telling me where most of the volume is taking place. And that's how you can see it here. It's being demonstrated here. Now, so on the basis of this, how I'm trading is that there is what's identified is this kind of oranges or gold color. Those are points of control. And the blue dotted lines, those are the value area high and low. The magenta colored, that's the daily range. So That's giving us a lot of information. Added to that, I have moving averages. Again, on a 60-minute chart, I'm looking at. So this basically has been range bound. Now, and you can draw channel lines right across there and right up there, and you're going to see how it gets narrow, narrow, narrow. So that's going to help you with your trading. But understanding now, what does the point of control mean? And this is where a lot of people get confused, because I'm using a term that just may not make sense to them. But what this is, the value area high, the value area low. So if I kind of open this up a little bit and bring it back down, you're going to see that there's the value area. Now, what happens? The market trades up to the top of the value area, comes back down, goes to the point of control, goes back down, goes to the bottom of the value area low, comes back up, trades to there. So you've already got a little bit of a range. And so it's not that it's chop, but the expectation is come down and test that, should go back up to there, back to the point of control. Now, what is all this really based on? It's based on supply and demand. So when the supply is that they're looking to buy, the supply that they need are sellers. So the market will move to value. And all I'm really saying is value is where buyers and sellers can meet and actually trade and do business. It is not saying anything about, well, gee, at 10,789 or 10,798, which is pretty much where the point of control is. Well, how is that value? Well, as value is worse at using the word. Is it a good value? Is it good for the money? It's good for the long or the short. That is not being determined. It is where right now, from today, where the bulk of the volume has taken place. So it's all right in here. And when buyers are moving quickly, then it shifts the point of control and it'll move up, and they're searching for value. So they're already going to the value area high. Well, they still needed more. So they took it up. When the seller stepped in, now they're looking for those buyers where they were gone. So they're going to continue to sell it until they find their level where they can get those orders filled. So that's that concept. Now, how do I actually use this? Well, in the beginning of the day, I've got a lot of these lines, and what they're showing me is extended points of control and a naked point of control, excuse me, and then extended value areas. And they extend because they were drawn. This one, in case, was drawn yesterday. And so it did not get challenged. It did not get taken out. So it remains. But then again, as you're trading, if the market was really going to start to rally, eventually I would expect it to go up there and test that, if not take it out. And the same with this, that, and that. So it's showing you levels that volume may get tossed to. That's where they may have to take the market. So that's one thing that I use during the day. But now I'm back down on a 30-second chart. And we're going to be looking at, it's not really doing very much. But here again, now what I have also is I have an RSI, and I look at it between well, now 30-second, but to tell you the truth, I rarely trade on a 30-second chart. So let me put it out to and be fair. And then I also use swing arm. And the swing arm is designed to basically follow moving averages and also uses Fibonacci sequences to work out where these arms are going to be. But this would be on a 1-minute basis. This is on a 5-minute basis. And I can continue to form those just by saying, going up to the 15-minute, it's going to redraw them and put them here. And here again, I have my extended value areas, the extended or naked point of control. And I have my moving averages, this being the 200 on the 15-minute. As a day trader, those all become important. When it breaks above or below a moving average, it's giving you clues about what's happening market-wise. Now, to tell you the truth, right now, there's not a whole lot of activity. It's going into the end of the day. And the tone has been down. It's just a continuation of yesterday. We're seeing these little pockets of, flurries where buyers come in. And then again, I'm just looking at these particular, where the moving averages are and what can I expect? They're coming down, they're reaching a level, possibly that was a fib level for me. And I'm looking and it was pretty oversold here. It was pretty oversold here. I'd be looking for it to rally. And then I can start to decide, choose where I think it's going to go. Going to break above the 8. I'm looking for it to go to the 20. It rallied around the 20. When it broke the 20, it was going to the 50. When it broke the 50, it was going to the 200. And that's pretty much as the buyers are coming into the market, they're already placing in an algorithm that's going to control those orders and choose, how far they can push to get that order filled. And many times they're using the moving averages as an area they put an order to buy, and they may even stick that as the limit because they have so many to buy or to sell if it's coming back on the other direction. To be more specific, I hope that was kind of what you were looking, how I identified choppy untradeable. Now, choppy untradeable to me is actually when it's going to get like in here and it's not breaking out either way. So it's building a range. Now, another way that I identify those, again, I'm looking for now it's going to go beyond it. So I'm looking for the market to put in a little bit, but if it's going to come down here and sit here, then I'm going to expect it's going to trade between these moving averages for a little bit. But then they got a big enough order, came down, brought it down to here. So again, this brings this into line. It's going to come down. I'm looking for support, but I'm likely going to be looking for the market to turn and move to the upside. It is a very difficult market today because we have different stocks that are going up and different stocks that are like Honeywell today, finding its footing. Boeing, big stock in the Dow. So this rise is going to have an effect now, of course, on the Dow. Right now, it's the largest contributor to the Dow not being down 200 points. Or it also has an effect on the S&P. So what I've also done ahead of time is you can always, this is a lot of information that you can find. And I'm hoping that you can now see this, which I think you can. This is the NASDAQ, but this is the breakdown of the NASDAQ. So in here, NASDAQ has 102 stocks. I know it's the NASDAQ 100, but Google, AKA Alphabet, shows up twice. So that's why it's got 102. Now, you can see the weighting. So when we go over and we're looking, seeing what's moving in our market, Apple. Yes, very big economic numbers coming tomorrow. The employment situation, I'll discuss that in just a moment. That's a very good catch. Thank you. We can see here that Apple has a 14.2 weighting in the NASDAQ. If I go over to the S&P, it has almost an equal amount. Microsoft, almost 10% weighting today. Amazon, 6, Tesla, 4, Google combined, right? There's the two Googles. Google just G-O-G-G, G-O-O-G, and G-O-O-G-L. So it's A and the B stock. Combine that, and it's almost 7%. Here, we can look at it there. Over 7%. Contributing to that. Now that is not correct. So let's go back and take a peek at that. There we go. Now we got what's really happening today. So same deal though, with both of Google stocks A and B being down, you're going to see that's what's contributing a 7.5% or 7% to the overall move in the NASDAQ. Apple on its own is 3.6% of that move. So when Apple moves further lower or starts to rally, it's going to have the same effect. So keeping an eye just on what is actually trading and why helps me determine. But tomorrow, we're going to get a continued view on inflation. And as the Fed has been talking about, as Chairman Powell has been talking about, that they need to see a little bit more people being unemployed. And I think that's a very strange statement, particularly if you've ever been unemployed in a period of inflation and you're trying to live off of unemployment or off of your savings, and you're watching how quickly it's going to just evaporate on you. So it is a very important number, because if it continues to show that people are going back to work, which really in my heart, and I'm being honest with you, my heart is happy. People having to live under the stress of not having a job, not being able to afford to take care of their families or even themselves is horrible. And I think right now we are in a very difficult period because there's so much inflation that every time we turn around, you're going to buy food and the prices, before maybe you could buy groceries for $40 or $50 to feed a family of 3 or 4. Now it's costing you $80 to $100 because of inflation. So you look into the Fed to go like, well, what are you guys doing about it? Well, we're trying. And granted, I think we need to understand that there is so much money out there in the system. There's so much money in our markets that in and of itself is inflationary. Now, how, you might ask? Well, if we take a serious look at what got put into the system from 2008, 2009, and then again in March of 2020 on through, I believe, 2021. So post-pandemic, that low, March 2020 low, how and why did we get that gigantic rally? I'm trusting you can see my chart now again. And if I go back out to, I got to go to my weekly chart. That's that long ago. This rally, $13 trillion got injected into our system, into our banking system, into corporations, into our pockets. The government had to bail out companies, but more importantly, had to bail out us as the citizens because we couldn't leave our homes. How could we get anywhere? Many people lost their jobs because the business closed. And so you don't get to put that much into the system and then expect that things are just going to be hunky-dory when it's time to turn around and basically deal with the inflation that's been created. Now, back in the day, or the last time that we actually saw inflation at the levels that we are at now was 1981. Different scenario, right? Because we're not talking that $13 trillion was tossed into the money system, into the economic system, and take onto that in 2009, $8 billion got put into the system to bail out corporations. Now, if we didn't do that, the corporations would have went belly up and we would have had massive unemployment. We would have been in deep trouble. Right now, they did the same thing, right? In 2020, we had 2 years of this incredible rally because our money was cheap, very, very cheap. When we take a look at the bonds in the 30-year bond, I wish I could find, I can never remember the symbol for the yields. But if I go to my monthly maximum chart, that level was basically 0. And if I go back, it doesn't go back far enough to show you that low in bond prices in 1981. So the rally from 18% Fed funds rate to basically zero was 40 years. This is the correction. This is the correction of how and why you would keep interest rates so low for so long. Everybody filled their pocket. And now all that money is out there and people are getting stuck because interest rates are going up. And what do? You know, you've got mortgages, you've got cars, you've got all of these things, you've got credit cards, and people are getting crushed on it. And the decline, you're very welcome. It's something that I don't mind doing, but thank you so much. It's very kind. And to really believe that basically what's that high? March of 2020, basically when we topped, but we had a secondary top. So we've had several. And to think that, well, that's that low, but we didn't really start to hike interest rates as like six months ago. So we're in 2022. We were already coming down. We were already correcting on the long end of the curve. The short end of the curve did not. The short end just kept going. And to realize, I wish I could remember the year, I wish I could pull it up because it is such an interesting chart. And again, what it's going to show is the yields being so low, but the rate being up here. So again, we went from there to there because remember, higher rates, lower bond price. If you understand a bond, it's priced at par or 100. So if you're having higher rates, you're going to pay less for the bond because the rest is your interest. Now, you buy the bond at almost what? 0.3%. You're paying top for the bond. Those interest rates start to go up. Oh, great. You're receiving your coupon of 0.3% interest being paid to you for lending that money to the government. Meanwhile, the government's like, well, we can't hold it there anymore. So our rate is now 4%. 4%. What's the price of your bond? Boom. So what you get in a coupon is not equaling what you're losing in the price of the bond. So it has a double-edged sword. And that's kind of what we're confronting. I know, and the thing is, it's like the people say, you know, well, you got to do it slower, you got to do this. It's like, you know, it truly would benefit us to get all our medicine at one time. Let me just take it all. It's not going to taste good. I'm not going to like it, but let's just do this because we need to get back to more normal living. We need to get a grip on the price of gasoline. We need to get a grip on the heating oil prices. We need to get a grip on the food prices, the other commodity prices. And we're at the mercy of so many different factors that are coming in now. So when we're dealing with inflation and we're dealing with what's going on in our country, it's more than just higher interest rates. There are a lot of things contributing to the mess that we're in, and much of it is within our country, but a lot of it is not. And because we've become a global economy, we are dependent on other countries for many, many things. And now we're learning. We're dependent on our chips, right, from China. Apple is dependent on China to make this the iPhones. Now that's a maximum monthly chart, so that's not going to make any sense to you. But I'm going to come down to the daily chart in Apple. See what happens? Gap, right? Just gapped today. That was yesterday. Here's today. Gap's lower. Why? Well, they are not able to get their iPhones from China. There's a problem there. So this is what happens when even the best run, most largest corporations in our country who have a storehouse of money. Don't be fooled. Apple Computer has got, I think, 40 billion or more, just kind of sitting for like a rainy day fund, you might call it. So I actually do not feel that Apple's going to go bust. I don't feel that at all. But what we're really seeing across the board in our market is repricing. All of this needs to be repriced. And that is what we're going through. So I will finish because I know, oh, wow, cool, thank you. And that little sign, let me see if I can just do that. And then I'm going to have to close up because I know David's got somebody else coming in a minute here. So where is that on my keyboard? There it is. So that TNX. Okay, let's see. I just had it. TNX. Oops. Come on. Yeah. TNX. Don't think it's going to work, but let me just try TNX. Yeah, that's all I needed. Okay, this is a very cool chart. So we did get a bounce, but look at that. And that's a daily. Let's go see how much I can get. That's where we were. And this is where we went. That's where we went. Now, and we're rallying because rates are going up. So yes, it is severe. 4%, 0%. It's pretty hard. I've only got about 30 seconds. So I want to leave you with this. When you're looking at repricing, I call it the pecking order. And what sits at the top of the pecking order are interest rates. Now let's just walk that down and you get a little bit of an understanding on how this repricing, adjusting takes place. Interest rates up at the top, they're going up. What's next down? The currency. Dollars, how that's going to fluctuate. Then what's next down the line? Corporate. Corporations got to take all that data in and all this stuff and then figure out how are they going to, what do they need to do? Tighten up, they need to get more product out, they need to maybe not hire, they got to adjust their hiring schedules, et cetera, just what they're paying people, et cetera. How's it going to come down? And if you're a grocery store, well, you're going to raise all your prices because everybody's got to pay more because product, supply and demand, supply chain problems. We've had everything come in. Then come down, and now you've got retail. That's where me and you sit. We're retail. So we get to hold the bag because we got to continue to pay upline. So that's why it hurts more. And that's why it takes longer. And to believe that we're going to be all done with inflation and get it under control in 6 to 8 months, not going to happen. It takes a lot longer. So I think to put together, you have to have a realistic choice of what can I do? There are many, many things to trade, folks. There really are. Trading is robust. There's still a lot of money traveling back and forth each and every day.